Well, good morning. I hope it's a pleasant Sunday wherever you are today. We've reached the middle of January and winter has definitely arrived in Upper Michigan. But our subject this morning is not the weather. We're going to talk about investing. And even if you don't get directly involved with investing, the performance of the stock markets probably affect you. If you have a pension fund, a 401k at work, or an IRA, it's almost certain they are being impacted by activities on Wall Street. This morning, we're going to learn more about what's happening with those markets as we talk with someone who not only makes major investment decisions, but is a frequent commentator on national network business shows. We'll meet him right now.
From TV6, this is The Ryan Report. Now, here's your host, Don Ryan.
Well, Brad McMillan is the Chief Investment Officer at Commonwealth Financial Network, the nation's largest privately held independent broker-dealer registered investment advisor organization. He's the primary spokesperson for Commonwealth's investment divisions and is in town to speak to the Economic Club of Marquette County. He is a frequent commentator on the financial markets, U.S. economic policy, and the global economy for a range of media, including the Wall Street Journal, CNBC, CNN International, Barron's, and Bloomberg News. Today he adds TV6 and Marquette to that list. Welcome to the Ryan Report.
Thank you so much for having me.
Nice to have you with us. Before we get to all those serious market questions, let's find out a little more about you. Where do you call home?
I came from Delaware originally, but I've lived in Boston for about the past 30 years or so.
Okay.
It actually seems like a long time looking back on it.
Yeah. You went to school at Dartmouth, MIT, Boston College.
Yes, indeed.
Good places to start?
I had a great time at Dartmouth, too good a time. And then I went to MIT for a degree in real estate, and at Boston College I got a master's in finance.
Okay. You, it says you like to read extensively in history, math, and science, and you play golf very badly. Is that?
I am an extremely bad golfer. I go playing golf with my wife and my little son, and when he outdrives me, that's not the best part of the day.
Okay, so it's all just for fun. What is Commonwealth? Tell us about the organization.
Commonwealth is what's called a broker-dealer and an RIA. What we do is we work with independent financial advisors, and the key word there is independent, around the country. Okay. We're their back office, we're their research department. We do everything that isn't focused on them working with their clients. We help them however we can.
Okay. Mainly you give them a lot of advice, I think. That's a very important part of that process.
We give them a lot of advice. We help them when they have things that perhaps they don't know about. We give them the ability to do things as a business that they might not be able to do on their own. In other words, they have the backup of a major national company, the best. We've won 4 J.D. Power Awards. And they can use that to leverage it with their knowledge of their clients to help them out.
Okay. You know, the biggest question on everyone's mind is what's happening with this market, you know. Obviously, we're off to the worst first 2-week start ever. What are your just broad reactions to what's happening?
Well, the first reaction I have to that would be this. I got a call at 9:40 on the morning of the first Monday of the year. And I was talking to a person, they said, well, you know the January effect, as goes January, so goes the year. And, you know, is that going to be it for 2016? And I sat back in my chair and I said, well, it's been 10 minutes since the market opened. I think it's a little premature to write the year off. But that said, it's definitely a scary time, especially if you look at it in the context of what we've seen over the past couple of years in the markets. It looks even scarier because things have been extremely calm over the past couple of years. But nonetheless, at least so far, it's absolutely normal, and as scary as it is, I'm not that concerned just yet.
Are you calling this a bear market?
It could get there. I'm not ruling that out. There's been some damage to technical indicators and other things to the market itself. But the thing is, even if it does get there, the thing to keep in mind is the fundamentals are solid. The U.S. economy is doing well. 80% of the time to get into a real bear market, you need to be in a recession. We're not in a recession. We're not even close to one. The couple of times that we have seen a bear market when the economy is not in a recession, it's actually bounced back quite quickly. So I can't rule out a bear market, but at the same time, the underlying question, is this another 2008? I don't think so.
You've written about the fact that there were recession-driven bear markets and confidence-driven?
Yes.
Clarify that for us a little bit. And I think you've kind of touched the point already. But.
Well, if you look at why we get a bear market, stock values are based on two things. They're based on how much companies earn and how much people are willing to pay for that stream of earnings. Now, in a recession, you start to see earnings collapsing. So companies are naturally going to be worth less. And at the same time, you're also seeing people become less confident, so they're less willing to pay. So there's that double whammy when you get a bear market and a recession, okay?
Okay, go ahead.
Second of all, in a confidence recession, the companies are continuing to do reasonably well. Their earnings are not collapsing, which is where we are right now. They're not doing great, but they're not collapsing. It's just the confidence goes away, and that can come back more quickly.
And that's probably where we are now then, in a confidence bear market, or
Yes.
lead up to possible bear market?
Yes.
Because there are some good things in the economy, as you pointed out. Employment is fairly good. There's some fairly positive reports, I think, out there, aren't there?
Employment is better than fairly good. If you actually look at the way employment has evolved over the past couple of years, we're seeing employment growth at levels we last saw in the late 1990s. We're seeing employment growth at a better rate than we saw in the mid-2000s, which were not a bad time. In some respects, some metrics, jobless claims, for example, as a proportion of the workforce, we're at all-time lows. We're doing really, really well. Now, the narrative around that is, okay, but these are all part-time jobs, they're lousy jobs. That's actually not the case. I went back and studied that. I went and saw, again, how we're comparing with past booms. And actually, we're doing as well or better than we were in the mid-2000s, and consistent with where we were in the late 1990s.
So economically, the country is doing fairly well.
Economically, the U.S. is doing pretty well.
Probably as well as anyone in the world. From the,
Better than anybody else in the world.
And that may be part of the problem.
Well, that's a good point. The thing is, if you want to be anywhere in the world right now, you're glad you're an American. And we are suffering to some extent from the weakness in the rest of the world, but that's a relatively small part of our economy. So other countries are getting hit much harder because they have much more exposure. We're in a much better place.
We'll get back and talk about some of those points in just a couple of minutes. Back with more on the Ryan Report after we take this break. Our guest this morning again is Brad McMillan. He's the Chief Investment Officer for Commonwealth Financial Network. Let's talk about some of this. You know, when you watch the business news shows, and not particularly now, but in an average time, every day they want to attach the change in the market to one thing happening on that day. You know, it could be China, it could be the Federal Reserve, it could be the price of oil, it could be that Greece is going bankrupt, it could be, you know, terrorism, whatever it might be. But let's talk about some of those issues, starting with China. Why is China so important to us?
Let's take a step back, because you mentioned Greece, and I think that's important. If you remember back in 2011, Greece was going to collapse, the Eurozone was going to collapse, and the world was coming to an end.
Right.
And if you don't remember it all that clearly, there's a lesson in and of itself, because it didn't collapse. And now, a couple of years later, nobody cares.
Right.
China is, in many respects, the new Greece. China is going to collapse. It's going to take the global financial system down with it because it's growing a little bit slower. It's not true.
Okay.
It is not true. China has troubles. China's growth is slowing. China is trying to do a very difficult transition from going out and building roads and housing to actually having people buy things, to become an economy like the U.S. It's hard and it's slowing things down, and they may or may not do it. But the question is, are they going to collapse to a level that's going to affect the U.S.? I think the answer to that is no. First of all, the Chinese have incredible resources, not just financial, but political. Their government can do things that the U.S. government can't do.
Right.
So I don't think they're going to collapse. They're going to get it together, okay? Second of all, even if they don't, the U.S. is relatively insulated, as I mentioned, from the rest of the world. Our direct exposure to China is relatively small. You can put it this way. We didn't get the growth benefit when China was growing like crazy. We're not going to get the damage when they stop growing so fast. Now, will there be problems? Of course, but we're well positioned to ride them out. So China is the new Greece, which means it could be rocky, but it's not going to take us down.
In a sense, they're more dependent on us than we are to them, I think, economically.
I think that's exactly right.
Except in one area, commodities, and they really are affecting the commodity market, which really has an impact here in this region.
Right.
What's happening with commodity, especially metal prices?
If you look at the commodities market, people think economics is complex. It's not really. It's about supply and it's about demand. Now, we've had 30 years of China growing like crazy and buying more and more commodities, metals, oil, and the businesses have responded to that. They've opened up vast new areas of supply. Now China is changing its trajectory. It's slowing down. It's not buying nearly as much. But all of that supply is still built up on the assumption of this growth. So consequently, we've got a lot of supply and relatively little demand compared to what was expected.
Right.
So, of course, prices are dropping. And that's going to continue until the supply adjusts.
You know, we have a mining company here that's been here for over a century and a half. And just about, I think around 2005, prices really started to increase. And I think iron ore prices doubled or tripled. And the CEO at that time went out and bought a lot more properties. And he's gone now, and they're trying to put the pieces back together and selling pieces off pennies on the dollar, literally.
Yep.
But you know, apart from that, are we going to see some kind of recovery in the price of iron ore, or is that oversupply going to influence us for a long time going forward?
My guess would be it's going to be 5 to 10 years before we see commodities in general really start to come back. China is not, unless they really get in trouble, going to start the kind of infrastructure spending that they've been doing. The demand just isn't going to be there, and there's going to have to be a lot of companies, unfortunately, shutting things down on the supply side.
Okay. We also have a nickel mine here, which is fairly new and doing fairly well, although the price of nickel is certainly affecting them as well. So these commodities are really important. Let's jump on to something else. What about the price of oil? Now, you know, to the consumer, when the price of oil goes down and gas prices, and I drove by a station this morning, it was $1.79. You know, consumers love it. Why is this affecting the market in a negative way?
Well, you have to separate here the real economy, in other words, the place where you and I go and live and work every day, versus the financial markets. When the price of oil goes down, the profits and the values of the energy companies also go down with it. And that's a very large part of the market as a whole, much smaller than it used to be, but still significant. So even as you have a very positive effect, we've seen car sales go through the roof, okay, largely supported by lower oil prices. Nonetheless, the profits and the value of a significant part of the market are declining. That's the financial market story, and it's very different from the real economy story.
And that relates back to our last subject too, in that, you know, if the developers stop developing new fields, putting steel pipe in the ground, it certainly affects the steel industry as well.
Great
And I'm
point.
sure there are a lot of those kinds of issues throughout the economy. Okay, I've got some more questions. We'll get to those in just a couple of minutes. Once again, let's take this break and we'll be back with more on the Ryan Report. And again, our guest this morning is Brad McMillan from the Commonwealth Financial Network. I want to thank Rich Teggy from Marquette at the Wealth Strategy Group for helping to arrange Brad's appearance here today. And this is really what you do. You work with a lot of brokers. And I guess at this, you know, it's always a good thing for people to sit down with their brokers, whoever that might be, and kind of review what their strategy is.
Financial advisors can add a lot of value to an individual's end results. And that's what matters, is end results. And an advisor in particular can help people keep focused on that goal when you have pretty scary times like right now. You know, and that's what our advisors do.
Right. The one thing I wanted to ask you about, things have changed. You know, there was a time when you were approaching retirement age or retired, you got very conservative. You probably didn't even own equities. And that strategy has changed completely, hasn't it?
It has, and there are two reasons for that. First of all, what with all of the Federal Reserve's policy changes, you can no longer get a living return by investing in safe assets. You've been forced to take more risk. Second of all, because people are living longer, you're more or less forced to take more risk there as well, simply because you need your assets to last for longer over time. So there are two things that are pushing people out to take more risk, and because of that, they're much more exposed to the markets. And that's a real change, and that's something that is going to be playing out, particularly for the baby boomers going forward.
And really, there are very few conservative good investments you can make nowadays. You know, it used to be people could put money in a bank and get 6 or 8% or a CD.
Exactly.
That doesn't happen today. So, you know, finding conservative investments for people at that group has to be very difficult.
Well, it changes the conversation about what risk is. So, for example, if you were to look at a long-term government bond paying 2% versus a dividend stock paying 3%, you might say, well, the government bond is safer. But actually, with interest rates poised to rise, you might not get your money back in real terms,
Right.
whereas the dividends might increase over time. So you might look at that and say, well, from an income perspective, perhaps the dividend stock is better. And again, that's a very different conversation, as you said,
Right.
than people were having.
And there's some very good dividend stocks out there that can pay 5% in some cases.
Well, that's probably a little bit aggressive for the bluest of the blue chips, but certainly there are some that are worth a look.
I think AT&T's up around 5% now. One thing I didn't get to ask earlier, what about the Federal Reserve? Did they make the right decision when they raised interest rates, and they're continuing to talk about raising interest rates this year?
I think they did make the right decision. The question you have to ask yourself is not, is the Fed tightening, okay? They're not. It's still a they're still putting alcohol into the punch bowl. They're just putting a little bit less in. So to start to back away, now is the time, because there are signs inflation might come back, and if they have to act faster later, that would be much more damaging than acting the way they did.
Do you think they're going to continue to raise interest rates this year as they've talked about?
I do think they're going to raise rates. I see the economy as being in reasonably good shape, barring some kind of external event. I think the data is going to say to them each step of the way, yes, you need to keep acting.
When we get markets like this, do we get kind of a panic mentality sometimes?
I think we exactly do. And the great thing about being an individual investor is you're not forced to react with the market. As an individual, you can take the longer term view. You can keep your eye on your goal and say, gosh, the market went down. Well, tomorrow it may go up, it may go down some more, but that doesn't have anything to do with my long-term goals. We talked a little bit about Greece in 2011. Mm-hmm. We didn't go bankrupt, the world didn't come to an end, and most people aren't even going to remember that there was an issue. That's how you should treat this pullback too.
And of course, brokers and investment people can pull out that chart that goes back about 80 years, which shows a steady line going up, a little bit of dips here and there.
Exactly right. If you believe that the U.S. economy is going to continue to grow, and it is, and it's actually looking better than it has in years, then you want to stay invested.
We only have about 30 seconds. Probably a good time, though, for investors to talk to their brokers about certain stocks, maybe certain sectors, where the best opportunities may lie in the future.
Absolutely. As I say, advisors, if you're concerned about what's going on right now, talk to your advisor. If you are in a place where you're not comfortable, take a look at your portfolio. But the thing to remember is it's a long-term race. Don't get blown away by a pothole.
Okay. Well, I think your comments were pretty positive this morning, so I think I appreciate that. I think we need some positive news in this market environment. Thanks for joining us today.
Thank you for having me.
I'll be back with more on the Ryan Report after we take this break. Well, this morning I have a little nostalgia for you. With the cold weather here, I got to thinking about home heating, which reminded me of how things were when I was a kid. Hopefully this will bring back memories for some of you and provide some insights into how things used to be for those who are a little or a whole lot younger. When I was 11 years old, I moved in with my grandparents, and one of my memories involves the furnace. For later generations, keeping the house warm generally means turning a thermostat on the wall. Back then it was very different. Grandma and a lot of other people from that time had a furnace that burned coal and wood. And while some homes had what was called a stoker, which automatically fed coal into the furnace, we didn't enjoy that luxury. That meant you had to keep adding coal to the furnace through the day. And it was very important when you went to bed on a winter night to load the proper amount and do it in just the right way so it would continue to burn through the night. If you didn't do it just right, it could be awfully cold by morning. Staying warm involved a lot of work in those days, and I was called on to help out. Getting enough fuel to last through the winter was part of the planning. The coal delivery truck would back up to a basement window and dump a load in the coal bin. so that didn't take much effort. But they also used wood to get the fire started or restarted throughout the winter when it died out, and that meant at least a couple of times in the summer, a truck would dump a big load of wood slabs in the front yard. My job was to get it into the basement. It was no easy task. It began with carrying armloads of wood from the front yard to a basement window on the side of the house and throwing them in. After tossing in a few loads, I went inside and piled up the wood so it would fit in the space available. That whole process was repeated a number of times until it was all neatly stacked in the basement. The way the heat was distributed through the house had a lot of disadvantages, but also one big benefit. The furnace was in the basement, and directly above it on the main floor was a large grate, probably about 4 feet square. All the heat came up through that grate and had to find its way throughout the house. There were no fans, vents, or hot water pipes. This was a 2-story house with ceilings that were higher than the 8-foot height that's pretty standard today. On the ceiling of the main floor, there were grates about a foot square. There was one for each room on the second floor. All of the heat for the upper story had to drift up through those grates. I don't recall that it was ever too warm upstairs in the winter. I said the heating system had one big benefit, and that part was great. There was nothing better than coming in from the cold in the winter and standing on top of that big grate directly over the furnace. I can remember many times standing there and soaking in the heat. It was really a lot of fun to come in after playing in the snow. As you stood on the top of the grate, the snow and ice would melt off your snow pants, and the furnace would hiss and sizzle as the drops of water landed on top of the hot furnace. For me, thinking about the warmth and that sizzling, hissing sound is a very pleasant memory. But I have to admit, turning the thermostat on the wall has its benefits too. I'll be back in 2 minutes. Well, it's time to wrap it up for another week. The Today Show is anxious to get started. Thanks to Brad McMillan for joining us today. As I said at the outside, he's frequently a contributor on the major business network shows, and it was very pleased that he could share his investment insights with us this morning. We'll be back at this same spot next Sunday. I hope you can join us then. Have a great day.